Prices and terms of junior mortgage. Commonly, a second mortgage transaction is made a specific contract interest rate combined with a discount or bonus on the face value of the note given by the seller or borrower to the investor. The discount is almost always a part of secondary market transactions. It is also frequently used in primary markets where maximum interest rate under insurance laws are low relative to secondary market yields. Optionally, contract interest rates truly reflect yield, but evidence on this point is not readily available. In public or other records that reported rates on second mortgage are only a little higher than rates on conventional first mortgage is explained in large part by use of technique of discounting and by the effects of insurance traded prices of second mortgage vary widely between and within local market. Many practices of second mortgage markets contribute to varying prices for mortgage of similar quality. Their local character, the limited organized outlet and investors, and the lack of knowledge of one-time participants seeking to sell-purchase money mortgage. Varying prices are also attributed to the imperfect nature of the market and to the varying quality of the paper quality of so imperfect a product is often a matter of individual judgment. Professional investors, however, generally look to the same set of criteria in establishing prices for second mortgage. The major important are location of property, type and characteristic of property, borrower's credit worthiness, terms of first and second mortgage, regular payments to principal, length of loan, and interest rate, amount of equity in property, amount of second mortgage note, age of second mortgage, new or second. The location of the property securing a second mortgage is of obvious importance because of the variation in state foreclosure laws. It is especially important in judging the quality of a mortgage offered in a market in a metropolitan area including more than one state. In addition to the obvious bearing on mortgage quality of the kind and conditions of the property, higher relating is usual for second mortgage on income. Properties owners are often corporations with favorable credit ratings, essential for marketing a second mortgage at almost any price. In addition, the value of such properties can be ascertained in relation to income produced. The terms of both the first and second mortgage are important in determining the quality of junior line. The terms of the first have an effect since inability of the borrower to carry first mortgage payments jeopardize the security of the second. If the second mortgage is not fully amortized at maturity, the remaining balance and length of life of the first may be received when the second mortgage becomes due and payable. If the first mortgage may be easily refinanced to provide funds to pay off the junior lien, the quality of the second mortgage is enhanced. The terms of the second mortgage directly affect its quality in the market. The longer of maturity and the larger the proportion of loan remaining to be paid off at maturity, the larger the discount, the higher the contract rate of interest, the lower the discount, the amount of equity a second mortgage borrower has in his property is a major consideration. It is a measure of protection against declines in real estate values. It is also a measure of the borrower's interest in maintaining ownership, especially in bad times. The amount of second mortgage notes sometimes influence the rate of discount because small notes at rate equal to rates on larger ones are not acceptable to investor when each involves equal quality and servicing a seasoned mortgage that has proved its soundness will command a higher price than recently created. The wide range of quality factors and other market imperfections in the second mortgage market led to wide variation in prices and yields. Yields are not earlier are a function of the contract interest rate discount and maturity. Limited observation indicated that in late 1956, with contract interest rate between 5 and 8% discounts on second mortgage secured by owner-occupied properties ranged from 2 to 6% for per year of remaining maturity, and on those secured by income properties between 2 and 4% per year within the range of typical maturities. This means that total discounts range from a low of 6 to 9% to a high of 40 to 50%, resulting in yields to investors of from 8 to 25% yields in the 10% to 15% range seemed quite common in secondary market. Investigated the high yields are due in addition to unusual risk to conditions prevailing in the second mortgage market. Imperfect knowledge of the market, limited sources of funds, the borrower needs for credit not available from financial institutions, and the willingness of sellers able to obtain inflated prices for properties on the basis of purchase money mortgage to discount such mortgage heavily for cash. Junior mortgage on most types of property carry maturities ranging between 3 and 12 years, considered able shorter than maturities of first mortgage. The 1950 census survey figures indicate that the median term on conventional junior mortgage on owner-occupied properties acquired in 1949 and 1950 was 8 years compared with 11 years on conventional first mortgage. Only one-eighth of conventional junior mortgage were written for maturities of 15 years or more compared with over one-fourth on conventional first mortgage. The difference between terms on the two types of conventional mortgage was somewhat narrower on rental properties. Apparently, since 1950, maturities on junior mortgages have shown little change, while maturities on conventional first mortgages have lengthened somewhat. Required amortization on junior mortgage increased markedly between 1950 and 1956, just as it had for first mortgage. Census data showed that regular payment on principal were called for on 82% of conventional second mortgage outstanding on owner-occupied on one-family houses at the end of 1956 compared with 70% in 1950. Comparable figures for conventional first mortgage were 91 and 78% respectively. A smaller proportion of rental property mortgage first and second are regularly amortized. Limited evidence obtained in the study suggests that partial amortization of second mortgage on both residential and non-residential properties in the early is as common as full amortization. Some brokers and traders found that junior mortgage requiring partial amortization only with payment in full at the end of a relatively short term were more marketable than those requiring full amortization in a relatively long period. Investors referred to commit funds for short-term mortgage with opportunity to renew a liquidated loan at the end of the contract period. Other professional investors, however, characterize the partially amortized junior mortgage as a contract with a happy hope clause and avoided it. The larger the balance payment required at termination, the stronger the faith needed that the contract would be fulfilled in the stated period. These investors preferred to put their funds in the more realistic, longer term, fully amortized mortgage.